Rich, you say that we need to get ready and position portfolios for inflation. Why and how do I do that?
Well, Tyler, first, thanks for having me on. Second, one has to admit that the economy is pretty strong right now, right? We have product markets that are very tight. We have labor markets that are very tight. And there's a wealth of data that shows that. The economy is doing very well. On top of that, and what's so unusual is that public policy right now is very pro-inflation. What I mean by that is we just got a very significant tax cut despite tight labor markets and tight product markets. Normally, you'd get a tax cut at the beginning of a cycle, not late in the cycle. Fiscal spending is up about 6-7% year on year now. Normally, that would happen early in the cycle, not late in the cycle. And now, on top of that, you're getting restrictions of products and labor. So we've already got tight product markets, tight labor markets, and now through public policy, we're going to restrict those markets even more. That is always inflationary.
So, Richard, I don't know if you could hear the president, and when he was being questioned by reporters, one of the reporters asked if his policies, particularly when it comes to trade, could lead to a recession, and he said, no, we're so far up that wouldn't happen. I mean, would you agree with that? Very short assessment by the president.
Well, I'm not sure. Just because the economy is strong doesn't mean it can't weaken. I mean, one should remember that booms are usually followed by busts. So just because an economy is booming doesn't mean that it can't
So
bust.
The trade policies could lead to a recession, you think?
Well, right now, I would say there really isn't a lot going on, right? We don't have a lot of firm policy, so I think it's a little premature to go down that road. But I think, yes, if you want to take a worst-case scenario, and you want to have a decision tree, and you want to take the most ill-advised decision every time, sure, I think you could have a global recession.
Pick up on that point, Brad, because you point out that in comparison with the stimulus that is in the pipeline, not only the stimulus that Rich just mentioned, but also the repatriation of $300 billion worth of profits or whatever it is. I mean, I don't know what the total number is, but whatever it is money coming into the U.S. economy that, by comparison, on its face, would dwarf the effect of any tariff, right?
Yeah.
And so that would allow the economy to motor along unless business confidence and sentiment erodes dramatically.
Well, I think that's exactly right. I think that the fiscal stimulus is an order of magnitude larger than what we're talking about in trade right now. So, for instance, the measures that are supposed to go into effect next week on trade, less than a $10 billion hit to the economy, whereas in fiscal stimulus, we're talking about, hundreds of billions of dollars. You mentioned.
How do you quantify that $10 billion? I'm curious if it's a direct impact, or if you also count the maybe loss of confidence or the reluctance of businesses to make decisions based on what's going on with trade.
Well, that's a good point. On that one, I was just doing the direct math. But yes, if there is a cascading erosion in business confidence, that certainly would be a further hit. But regardless, when you look at fiscal stimulus, on the order of a couple $100 billion, it's an order of magnitude larger, and we think that that's just coming through the economy now, and it's going to really serve to accelerate business spending tremendously, and it should dwarf what we're talking about.
So are you expecting another 20% plus earnings growth quarter as we go into Q2?
Yes, I do think Q2 will be in excess of 20%. We were 25% last quarter.
So when does that growth start showing up in a measurable way in the markets, which have been very choppy for the last several months?
Well, actually, I think that the market is sniffing some of this out already. Tech has obviously done very well for a little while now, and tech, I think, is one of the biggest beneficiaries of this business spending. So software in particular, we think there's kind of an unusual situation where you have the intersection of secular trend in innovation, which is driven by a digital transformation across industries, colliding with a cyclical upswing in business spending. And I think businesses, to get that productivity improvement, are turning to things like software.
That gets you to escape velocity, doesn't it?
Yeah.
That gets you going. Rich, final quick thought from you, please.
I would say, I think Brad said something that was very important there, but I think the thing that investors are ignoring is two things. One is the impact on the U.S. consumer. Have to remember the U.S. consumer has been in a disinflationary, if not deflationary, shopping environment for an extended period of time. We're talking decades here. And there could be a sea change in terms of what happens to consumer and consumer sentiment going forward if we're not careful here. And the second thing is, I think to some extent, this is a little bit of Washington shooting itself in the foot. The economy is extraordinarily healthy. Let it go. right? I mean, why have all these issues that are complicating matters? The basic underlying fundamentals are actually quite strong.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.